Okay. The last piece I want to sort of address when it comes to like these newer short answers is when we're thinking about discussing fiscal policy and thinking about one, like how tax systems are structured in the context of the US. And so just want to walk through like how our federal income tax is structured. Um, think about like what's happening with our top marginal tax rate, and then think about like a couple potential policies as well. And so we have tariffs. We'll think about other options as well, but how different taxes are structured, and what their ultimate impact will be on different citizens. That's what we want to think about for this federal income tax system. And so we'll kind of work through these couple questions piece by piece. But when it comes to like this first one, when we think about the U.S. federal income tax system, let's just take a look. We can look at like an older example, but the way our federal income tax system is set up is it is a progressive tax. It is a progressive tax that is structured as a marginal tax rate. Marginal tax rate is applied to what happens on each additional dollar. And so what that means when you hear people reference different brackets is that this first threshold here is taxed at 10%. Now, once you make more than $9,525, so once you move into this range, each dollar above $9,525 is going to be taxed at this new rate of 12%. And so we can think about an example. Someone who makes $50,000. Someone who makes $50,000, their first $9,525 are taxed at 10%. So we know that they're going to be subject to $9,525 will be subject to 10%. Then every dollar within this range here is going to be taxed at 12%. Now, their last bracket pushes them up to here. And so every dollar that they make between $38,701 and their $50,000 is going to be taxed at 22%. And so even though their income pushes them into this 22% tax bracket, they don't pay 22% on the whole lump sum of their income. They pay 10% on the first $9,500. They pay 12% on the dollars between $9,526 and $38,700, and they only pay 22% on every dollar above $38,701. And so this is what we mean by a progressive tax system, is that as you increase your income or increase your earnings, you end up paying a larger share. And so progressive taxes are classified as taxes that collect a greater share of income from those with high incomes than it does from individuals with lower incomes. So that's how our federal income tax system looks. And then when we think about that second question, like what happens over time with this top rate? Well, all we need to do is look at that top rate. And so what we're looking at here is like, here's where we're at now. We're at a top rate of 37%, and realistically, this is a 35% tax rate. But over time, we've seen that our top marginal tax rate has been much higher relative to our current situation. So we've seen top marginal tax rates as high as 94%. And then for most of U.S. history, it's been sitting closer to 70%. And so over time, our U.S. federal income tax system has become a little bit more regressive. It's still progressive in its general structure, but we used to capture much larger shares from top income earners. And so feel comfortable with being able to identify or be able to classify our income tax system within the context of a progressive tax rate. And then also feel comfortable with these other types of taxes. And so what happens when we have a regressive tax? Well, a regressive tax is a tax which people with higher incomes will pay a smaller share of their income in tax. And so let's look at these examples. We have a couple things here: tobacco, gasoline, alcohol, and sales tax. These are all examples of flat taxes. So, for example, let's say you live in a state that has a sales tax of 10%. And we have two different families of three who are purchasing groceries. So two different families of three, they're both purchasing about like around the same amount of groceries. So you have your setup with household 1 and household 2. Household 2 earns an income of, let's say, $300,000 joint, and household 1 has an income of $85,000 joint. Now, both of them will go to the grocery store at around the same rate, and they will purchase around the same quantity of groceries, but they're both going to pay the exact same sales tax on their purchases. And so when we think about like defining something as a regressive tax, we want to think about like who's bearing the share of that burden from the tax. That's going to fall much more so on our lower income household here, because that 10% that they're paying, they're purchasing the same quantity of goods as household 2, but that 10% is going to eat away a lot more at this $85,000 income than it is at this $300,000. And so think about the difference between our two different tax rates. For our income tax, as that household earns more, they end up paying larger shares. But with these flat taxes, it doesn't matter how much people make, everybody pays the same rate. And so when everyone pays the same rate, that burden, like who's going to bear a larger burden of that tax, it's going to be households with lower incomes. And so if you're a high earning household, then regressive taxes, you actually win out in those scenarios because it's not adjusted. These rates are not adjusted for how much you earn. So think about like sort of the share of the burden that's falling on each individual here, and think about the different classifications for those rates. That will help you work through these types of questions. Same thing with this option here. When we think about the application of tariffs, those are going to increase the overall price of all goods, because those are going to be distributed in the form of prices. We want to think about how those will eventually impact our citizens here. And so work through those definitions, think about how this applies there, but that will help you practice for this fiscal policy side. And any questions there, just reach out via email, or we can set up a meeting via Teams.